Why pay more for your precious metals from the big guys with offices on Wall Street and who bank with JP Morgan? From the basics like eagles, maples, rounds, and bars, to collector coins like the Silver Shield and Heroes SD War Collection, to our exclusive line of insurance approved TL rated precious metal safes, SD Bullion has what you're looking for at the lowest prices, period. Guaranteed. Find out why over 15,000 new customers have recently made the switch to buying their gold and silver from the dock. Give our team an opportunity to earn your business today at SD Bullion. Why pay more? This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us again this week is our good friend Dave Kranzler. Dave, it's great to have you back with us on the show.
Thanks for having me back on. It's great to be back.
Well, it's been a long, painful November here, and we're not even to Thanksgiving yet. As our listeners are likely aware, gold and silver sell-off continued this week. As we were chatting before the show, silver's now losing streak stretched to 15 days. Silver has held thus far the previous lows, just below $14 an ounce. A couple ticks traded there. What was it, Wednesday? Gold has placed new half-decade lows, but has held up significantly better than it looked like for there a little while interweek. It has rallied back above 1080, although selling off a bit here Friday as we record. Let's start with the trading in the metals. Dave, what's your thoughts here? I know we were chatting before the show about whether they have or have not bottomed. That's been really the question for the past year or so. Is there any reason to believe that they might have now?
Well, I think any conversation about the metals has to differentiate between the physical market and the paper market. I mean, every time they use the paper market to push the price lower, which is what we've seen for the past, 2 or 3 weeks, 4 weeks, whatever, the buying over in China and India starts to ramp up again. So, I mean, clearly lower prices are, cause a big increase in the amount of gold that China and India are willing to purchase. And that's your physical market there, because those guys demand delivery. And throw Russia in there too, because they've been increasing the amount of gold they've been throwing on every month as well. And then there's the paper market, which is London and New York. And I mean, as everyone knows who's listening to this, the ratio of paper gold to registered deliverable gold on the COMEX is pushing unprecedented record levels. I mean, when I first started doing this back in '01, I never would have in my wildest dreams ever would have thought that the regulatory authorities would let the paper to physical ratio become so imbalanced on the COMEX. I mean, we knew they were letting it get, out of whack for purposes of manipulating the price of gold and silver, but I mean, to me, the degree to which that ratio has it's just mind-boggling how high it is. It just tells us how desperate they're getting in order to keep the price down. I mean, they're keeping the price down to scare people away from buying gold and silver, because I do think they are running into problems finding physical gold and silver to deliver into the Eastern Hemisphere buyers. So they want to scare off Western, specifically U.S. potential buyers. Stay away from gold. It's only going lower. And they also need to keep the price of gold capped in order to support their fairy tale that the economy's fine, they're going to raise interest rates, that whole spiel. So, as to whether or not the paper price of gold has bottomed, there's a lot of traditional indicators that I look at that indicate it's a possibility. But again, if they've taken the paper to gold ratio up to 300 on the COMEX, what's to stop them from taking it to 500 or 1,000? No one's there to stop them. And it doesn't look like anyone's going to come onto the COMEX and stand for delivery. So, one indicator that has worked in the past. And again, I mean, the markets are so irrational and behaving in such an unpredictable manner now, and that's all the markets, not just the gold and silver market. One indicator that I've looked at is if you sort of watch the ebb and flow of the open interest on the Commitment of Traders report. And again, I discuss this report loosely because I don't fully trust the numbers that are reported. I mean, the numbers are coming from the bullion banks themselves, and if they report these numbers honestly, it would be the only area of their business across all their business lines where they report information honestly and accurately. So I don't know how accurate it is, but what happened when they started smashing gold and silver, when gold got up to 1180 and silver got up to the 1630s, was that the short interest in gold and silver that was taken on by the bullion banks reached like enormous highs, and their net short interest was extremely high. And on the other side of that was the hedge funds. The long position of the hedge funds was extremely high. The short interest was extremely low, and their net long position was extremely high. And that usually signals that a price onslaught's coming. Well, the price onslaught happened, and as of last Tuesday, which is unfortunately the COT report is delayed, but as of last Tuesday, it looks like the bullion banks covered a significant portion of their shorts as the price went down, and the hedge funds dumped their longs and went short. I mean, this is a wash, rinse, repeat scenario that's been going on for at least 12 years. It's a pattern, and typically when the bullion banks cover their shorts and add a lot to their long side, that usually means they're getting ready to take the price back up. I mean, it's an easy way for them to fleece the hedge funds, and most of the hedge fund trading on the COMEX is controlled by black box algorithm programs. And I just happened to notice, now again, the open interest as of last Tuesday on the COT was something like 436,000 contracts. And the open interest as of yesterday was 423,000. So that means there was another 13,000 contract reduction in the open interest. And I'd be willing to bet that what we'll see when the report's released later this afternoon, that the bullion banks continued to cover shorts and add to their longs, and the hedge funds continued to dump their long side and add to their shorts. And that usually marks a bottom. And I think, as we were discussing earlier, I think Eric's right. I do think we have a short-term bottom here. Whether it's a permanent bottom or not, it's hard to say. We certainly haven't.
That's the key point. I mean, we get constant grief from folks saying, hey, you're constantly calling the bottom and you're proving wrong, and that's just the nature of the game, given the concerted efforts of the powers that be to keep this price down. I mean, as Bill Murphy jokes all the time, the highest and strongest forces in the world are pushing prices down. The economic interest behind the gold cartel's efforts is basically all-out war.
That's right, and it's psychological warfare. It's psyops, and that's what they're doing. Yeah. I mean, the sentiment in the precious metals market, the measured investment sentiment's about as low as I've ever seen it, and I think I've seen graphs that take the sentiment level back to where it was, I don't know, in the early 90s, or maybe even after the bull market ended in the 80s. So, they've effectively accomplished their goal in that area. But on the other hand, I mean, you can't pick up any mainstream investment rag or financial rag and not find extremely bearish articles about gold. And to me, that indicates that everyone's on the bearish side of the boat. And obviously, we know what happens when everyone's leaning the same way in the markets. And I do think that for now, the Fed has the ability to contain the markets, both the stock market and the precious metals market. And I don't think they're going to be able to contain them forever. And at some point, the balance is going to tip, and I think we're going to see a heavy washout in the stock market. And I think a lot of that money is going to flood into the precious metals, paper and physical.
If we want to talk about the Fed for a little bit, my perspective here is really the last month has been what we've seen is a lot of dollar strength from the Fed jawboning, telegraphing, acting like they're going to hike rates in December, and pretty much everything we've seen, I believe, has been now priced in, which I think you probably have up to maybe about 2 more weeks possibly of this trend to continue. Dollar strength and commodities across the board getting hammered as everybody piles on to the MSM notion that Feds are jacking rates in December. But so, I mean, really either way that plays out, if they do go ahead and raise rates, I think really within the next week or two, that's all going to be priced in, and you're going to see a sell the rumor, buy the news event in gold and silver. And then if they don't raise rates, you're going to see a much more significant rally as, like you alluded to, Dave, everybody's on one side of the boat, and if the Fed doesn't then follow through 9 days before Christmas and jack rates up, you're going to see a somewhat strong and perhaps volatile move to the upside in the metals.
Totally agree with that.
Yeah,
exactly my thesis as well.
It's kind of funny that everyone talks about dollar strength out there because it's really kind of relative. I mean, I'm looking at a long-term graph of the dollar, and we're not even back to the highs in the dollar index that we were in early 2015. I mean, it's been a straight-up rally for about 2 weeks in the dollar, and perhaps that's because the market really believes that the Fed's going to raise interest rates in December. But on the other hand, I mean, you know, a strong dollar, I mean, let's face it, these guys know the economy's not doing well. I mean, you'd have to be blind and deaf not to see all the data that's been coming out, especially the retail sales numbers recently. They're terrible. And so, I mean, and they know that a strong dollar exacerbates a weak economy. I mean, corporate revenues are declining, corporate profits are declining. Every company that reports is telling you things are not good right now. Caterpillar's like death warmed over, and that's sort of a global barometer. But the narrative is that, oh well, the whole world's like going to hell in a handbasket, but everything's fine here in the U.S. Right? Okay.
Yeah.
Well, how come there's no imports coming into the U.S. ports? How come all the trucking and freight indices are collapsing? I mean, that tells you there's no meaningful economic activity going on in the U.S. either.
Right. I mean, when you step outside the realm of Forex and put one's frame of reference into global macro, what we have is not a strong dollar, but very weak other currencies and a deflationary cycle that is now ramping up, and pressure within the global shadow banking system with assets under pressure, and that's creating capital flight into the dollar. I mean, and then you add on top of that the currency war aspect, you know, China recently devaluing and on, and that's giving a boost to the dollar, combined with this whole thesis of, oh, the Fed is going to start normalizing interest rates because the unicorn of healthy economy is just over the horizon.
Well, you know, I actually think that the massive dollar strength that we saw, the dollar really took off in mid-2014, and then that was supposedly triggered by, you know, this fear that the Fed was going to raise it. I don't know why everyone's shaking in their boots over a potential interest rate hike. I mean, we're talking about 0.25%, 25 basis points. I mean, it's nothing.
Well, but you know, they're just leading people around the nose with the trend change thesis. You know,
right, but
traders.
If anything, the fact that the Fed's been unwilling to even raise the Fed funds rate by 1/4 of a basis point tells you that something underneath that they know about, that we know it's there, and they know what it is more than we do, because they see all the, you know, much better data than we do. There's something really ugly under there, and that's you know, there's been a.
And it'd be one thing if this is 2010 or 2011 and we're arguing about a 0.25% rate change, but it's 2015, almost 2016 now. I mean, we're
right.
We're getting near 8 years after the crisis here.
That's right.
Yeah,
and what's interesting is you know, and I guess Zero Hedge is at the forefront of this. They're trying to stir up a debate about what these negative swap rates mean. You know, the swap rate to swap from floating into fixed is lower than the equivalent treasury yield. and they've gone negative. Well, if you look at a long-term graph of that and go back to '08, those spreads in the 30 out to the 30-year have been negative since 2008. And they bounced briefly when QE was going on, and they've gone down again. I mean, they've basically been declining since, again, I don't have the graph in front of me, but let's just say 2011 for the sake of argument. But they never went very positive. And it doesn't matter what the specific technical reasons are for it. It tells you that something is very, very wrong in the global financial system. And that's not just everyone but the U.S. It's especially and including the U.S. There's something very, very wrong going on out there. And you're seeing the desperation of the Fed and the other central banks leading all the way up to the BIS to keep it contained with the extreme volatility that we're seeing in the stock market now, and the volatility we're seeing in the metals, and the extreme effort going on to prop up the stock market and to keep a lid on the price of gold.
And all of these spinning plates that they're trying to juggle are getting more and more complicated with each passing month. I mean, that's the problem with this enormous amount of leverage that exists in the system as but a product of this reflation of every busted bubble cycle that we've gone through over and over again for decades. And now we're definitely in the end game. And I just find it kind of ironic that the Federal Reserve and Janet Yellen have been talking about, well, we're going to be data dependent and we're going to make our decisions based on the health of the economy, on and on. And here we are with retail sales rolling over significantly, even witnessable in the upper end of the retail market, which was kind of carrying a great deal of retail sales in the United States over the last couple of years, because the wealth effect was helping the upper class live high. But everything is rolling over now, and everywhere you look, whether you're talking Dr. Copper and the signals that the commodity sector has been showing, the Baltic Dry Index scraping new lows, the retail shock that we saw, and you did a couple of great articles on this too, because when you see Nordstrom suddenly getting shade for a huge intraday move, it just shows that the expectations built into the understanding of what retail sales are doing were completely wrong. And the Fed knows all this stuff, and how are they going to be able to orchestrate a interest rate hike thinking, or trying to paint this picture that the economy is doing well smack in the middle of the most important retail sales period in the entire year? I get the sense that we're going to see the Fed not raise, and that's going to contribute to a stock market pop sometime in December, associated with all the nonsense propaganda we get about sales being pretty strong in the retail sector, and then in January and February, when the postmortems come, and looking back with 2020 hindsight as to what really happened in the retail sales, we're going to see lousy numbers, and all of that's going to contribute to the stock market rolling over in 2016. And when that happens, Dave's right. It's going to contribute to people looking to buy precious metals just because they want to diversify a little bit in their portfolio. And all you need is a very small percentage of the conventional managed money out in North America, shifting just a tiny bit into metals to actually put a bid under them and put some pressure on the cartel, because a lot of those buyers do buy GLD and they buy futures contracts, and you get more interest from just people in general wanting to get exposure. And then we got the tax law selling coming to an end probably only 15 days from now in the mining share space. I think we're setting up to, in the very least, see a period where the cartel backs off and prices move higher, and then you can make that forecast and say, yeah, that's a bottom, but it may not be the ultimate bottom, because we very easily could see exactly what happened in other periods. This is very similar, actually, to what happened last year. We bottomed out in October and then went up a lot and then got beaten back down smack in the middle of the strongest seasonal period, which was highly suggestive of cartel pushing the prices down. And we did that oscillation dance twice, once in November, once in December. Then we bottomed in December and rocketed higher to January 24th, 2015, as the paper traders were piling on, because everyone was pretty much just burnt out and not participating. And then new money came in that pushed the prices and competed against the cartel's efforts to play their games in the paper market. And I think that cycle is going to repeat. What happens in February and beyond, for example, once all of that interest is able to have been corralled and faded away, as the cartel does in their price management efforts when it comes to how they manage psychology of markets. I mean, that's an open question, and it's hard to predict how long this move will happen. But I still think that, at least in the next 3-month window or so, it's fair to say that we probably have bottomed and going to move up. But that's not a forecast saying that, it's the end of the ultimate bear phase and the beginning of a brand new bull market that'll sustain itself for years, even though I think at some point that's going to be where we're going.
Well, here's something that I think is interesting to contemplate, and I do think that when this market does turn around and head higher, and I who knows when that's going to happen, because as I mentioned earlier, they seem to be willing to use as much paper as they need to keep it contained.
Yeah.
Eventually someone's going to call them on that bluff, but who knows when. It's impossible to predict. But I do think, and we saw a preview of it this summer when all of a sudden silver went from $2 premiums to $5 and $6 premiums, and it went from relatively plentiful supply to relative scarcity. I do think we are going to reach a point at which it's going to become next to impossible to buy gold and silver on the open market. I mean, you'll be able to buy it probably privately through like Craigslist or whatever, and that's because I think at some point, as I mentioned in my blog post that I posted last night, I think we're seeing Gresham's law happen right now, which is that the bad money chases out good and people hoard the good money, and at some point there's going to be such a demand for physical good money, i.e. gold and silver, that it's going to completely outstrip the supply, which is something that's been going on for the last 10 to 15 years anyway. But a lot of that gold that's been above ground has been recycled and hypothecated and leased out, and it's I think it's starting to disappear. And I think we will, and I don't know if this will happen, next month, next year, whenever, I don't know. But I do think that people who do understand what's happening, who either don't have physical gold and silver or have some but want to buy more, I think now is as good a time as any in the last 15 years to add to your positions or to start a position. And I say that I don't have any vested interest in retail gold and silver sales. I don't have any vested interest in that.
I mean, when you take a look at the big picture, if you step back a little bit, it really is remarkable that there's even any sort of premiums rising or shortages, whether it's just at a retail level or if there is some underlying wholesale shortages in silver at all, when you realize the total percentage of investors who are invested in the space. I mean, it's less than 1%.
And premiums are supposed to be a thing that advances when prices are moving up in a normal market.
Right.
I mean, that's the most absurd thing about all this. I mean, we're supposed to believe that there was no retail shortage. Well, there was. I mean, yeah, of course, they could have conceivably been able to source some 1,000-ounce bars and you see some more flexibility with national mints and so forth. But the reality is that this is a product of artificial price signals being shoved down everyone's throat from a cartel.
And that'd be a good time to give the listeners a quick update on what we've seen in the physical markets over the past week. Really, over the past probably 4 to 5 weeks, we've seen an improvement in availability and supply, and that all changed rather suddenly early on Tuesday morning. All the authorized purchasers from the mint that we talked to just described remarkable demand it started with Silver Eagles and then really across all silver products. Maybe not quite to the level we saw in July, but pretty much everyone you talked to said they were getting phone call after phone call, taking down 50 to 100,000 coins at a time. And we saw premiums rise multiple times intraday on Tuesday and Wednesday. On the wholesale market, they've risen about probably 60 to 80 cents from the beginning of the week. And that's after about a month of continual declines and improving availability. And as I take a look at the mints numbers here, as we record this on Friday the 20th, the U.S. Mint has now sold 42.9 million Silver Eagles for the year. about 3.1 million for November. So if you take next week's expected allocations, they're going to be just shy of 44 million ounces. And the wholesale market pretty much this week has, really on Tuesday and Wednesday, the wholesale market completely sold up of any built-up inventories over the last couple of weeks, and most dealers are actually now nearly sold out on next week's expected allocations. So while the U.S. Mints announced sales of 42.9 million ounces right now, the actual wholesale market is probably closer to about 44 million coins that they've already sold. And in my personal opinion, I don't think the Mint's going to produce much more than 45 million coins this year. Once they hit that number, I think they're likely to start patting themselves on the back, start throwing some cocktail parties, and call it a year. So, I mean, you're really looking at about 1 million coins between now and mid-January they're going to be available. So you're looking at 6 to 8 weeks. In my opinion, that the Mint's going to crank out about 1 million coins, and the market's already taken down, which is 1 week's allocation and not enough in an average week right now. So I would certainly expect premiums to continue to rise over the next probably 4 to 8 weeks as first Silver Eagles become short again, and then the demand from there shifts to maples, kangaroos, other government products, and as well from there, then you see it spread out into private sector rounds, bars, and so forth. So obviously the futures price and the papers pricing will play a big role in that. If silver over the next couple of weeks trades sideways to upwards a little bit without any urgency, you're not going to see the premiums move quite as much as if we see any further downside action with a 13 handle. It wouldn't take long to get right back to type of levels we were seeing in August and September.
What's going on with 90% silver? See anything interesting?
Premiums have risen, but it's not. It's still available on the wholesale market. It hasn't seen the levels of shortages that we saw back a couple of months ago. But I mean, you're still talking premiums well higher than Silver Eagles for 90%, and it really still, it's not too distant memory that a year or two ago you could get 90% silver for under the spot price on the wholesale market. So
yeah, I mean, one thing that might be interesting to consider is that we saw a lot of the stacker community get re-energized over the summer and basically buy all the way through the end of September, and they tend to be the buyer for the 90% first and foremost. And I'm kind of wondering if there was some folk who bought and then kind of gave up hope as Shemitah didn't manifest, and a lot of the other things that people were thinking were to come did in fact not come. I wonder if that's why we see a little bit more of physical being available now, with not so strong hands letting some of what they bought go, because we literally had 90% available for, what was it, about a 3-week window or so?
I think it was more about 6 weeks that there wasn't any available period.
Yeah.
It really wasn't until silver moved higher by a buck or two before some investors finally sold some into the market.
Yeah.
Just to weigh in on this, I mean, the 90% silver, that market's dependent on retrading, right?
Yeah.
So I think that when the sort of the bid side fades, I think that's when people either start selling or take profits in what they're sitting on. That's the type of market where it's going to trade, and when silver becomes scarce, that market becomes completely illiquid on the offered side, and when silver starts trading freely again, then it seems like that market frees up. At least that's what I've observed 12 to 15 years. And when you had mentioned, Eric, a little bit earlier, that it seems like there's supply out there, I do think that I think the Mint's under marching orders to try and crank out as much silver as they need to. I think it's an embarrassment for them when they run out of silver and premiums go up.
I would disagree with that, Dave, and I would point to one explanation or that I would say of why I pretty strongly disagree with that they're not producing anywhere near as much silver as they need to. They haven't run the San Francisco Mint the entire year.
I'm not saying that they're not producing I'm not saying they're producing as much as they need to, but they're certainly getting enough supply on the market so that now you don't have our the precious metals community out there raising a lot of noise about manipulation and shortages, etc.
Yeah,
but
I think the truth actually is in between both of what you guys are arguing. I mean, and the other prima facie evidence you can point to is that the Mint did not shut down production, even though there were rumors all over the place 2 months ago that they were going to shut down really early this year. So they obviously care about not having egg on their face.
Well, and if they're if they're not producing San Francisco Mint coins, it's probably just so that they can divert supply to the main mint production, just the boilerplate mint production, the generic bullion silver eagle coins, because that's where most of the demand is.
I mean, the San Francisco Mint, those are just bullion silver eagles, just like the West Point Mint. They don't sell them any different. We're not talking about proof coins here or anything special.
Yeah.
I mean, the last few years, they've been concurrently running the West Point Mint and the San Francisco Mint, supposedly to crank out more volume. They haven't produced a single bullion silver eagle from the San Francisco Mint in 2015. Now,
and guess where the West Point Mint happens to be situated geographically close to?
Right, but I mean the whole argument. Argument this year.
Depositories.
The whole argument this year from everyone arguing that there was no shortage was that it was just a production minting issue at the U.S. Mint. And I mean, if that's the case, why in the world would they not have cranked up the San Francisco Mint if they're really trying to produce as many coins as possible, but they just can't stamp out as many, that their stamp presses aren't working, then certainly you, Eric, or I, if we were running the show, we'd like, hey, we got a whole nother mint here in San Francisco. Maybe we should flip the switch.
What I would suggest, though, I mean, let's differentiate between retail and wholesale demand. I mean, or the wholesale market. I mean, obviously, there's enough supply in the retail market now to keep the premiums down and to keep articles about a physical precious metals shortage at a minimum, because the volume was turned up very loudly over the summer in that regard. But I do believe that the wholesale market, i.e. the institutional bar, the LBMA bar market, I do believe that's running thin. I mean, we're seeing backwardation in London in the gold market, and I believe there's also backwardation in silver, which tells you right there's a shortage of institutional gold or wholesale gold.
Right.
And obviously we've seen, quite a bit of gold leave the eligible account in the JP Morgan vault recently. And again, I can't emphasize enough the fact that they're willing to go out on their skis to the extent that they have, to use paper to keep the price of gold contained in the paper market. I mean, that just reflects the fact that they're desperate to mute out all possible demand for that other than what they know they can supply, to the buyers in the Eastern Hemisphere. And they've obviously been shaking down as many countries as they can to get gold out of it. I mean, we saw what happened with Ukraine gold. We saw what happened with Venezuela's gold. I mean, Goldman Sachs was working on that gold for over a year. People just forgot about it. Goldman proposed a leasing deal to them over a year ago, and they said no. And then a year later, after a year of currency turmoil and sovereign budget deficits there that became completely unmanageable, they finally agreed to sell some of their gold that Hugo Chavez had taken a lot of pains to repatriate because they needed the money. And to me, that was just a blatant shakedown of Venezuela's gold. But I mean, it wasn't even that much, but it was probably enough so that the bullion banks could keep the gold flow uninterrupted to the east. And I do think that the wholesale market is getting tight, and I think it's getting tighter. And I don't think, I don't know if they have a way to address that or if they've figured it out yet.
Certainly ain't going to be coming from India. There was a funny story on Reuters yesterday talking about the first 2 weeks of Modi's gold plan to extract gold from these temples and individuals who want to buy gold, and they only have been able to sell 400 grams in the last 2 weeks, which is a shy of 13 troy ounces. I mean, that's astounding. And then we, have to be a little careful with this. It's a preliminary report, and India is legendary when it comes to bureaucratic nightmares.
Hey, Dave, we'll have to shoot Modi an email, and we'll give him Eric's contact information. You can probably get more gold from Eric.
Honestly,
yeah, just pocket change, guys.
Honestly, that was predictable, and I would also suggest that program that was rolled out was under the heavy influence of the United States.
There's no doubt that that's what's going on. I mean, they had domestically, their political and economic elites have the interest of trying to protect their currency and all of that other nonsense that comes in to play when it comes to the problem they have with gold imports, because they really should just classify it as a capital asset, and and it would be money as opposed to something they're purchasing and giving them current account problems. But that's a story for another day. The temples may be a plum that they may be able to shake down, because you're talking about individual people or a small number of people running large temples, and they're corruptible. But in terms of the peasants, in terms of farmers and average middle-class people in India, they know what's going on. I mean, the rupee valued against dollar by something like 40,000 times or so over in the last 40, 50 years. I mean, the depreciation of the Indian rupee has been amazing, and as a result, the Indian people, on average, are really smart. They understand. They don't want to let go of gold, and then on top of that, you have the cultural affinity and the gift-giving and the bridal tradition of dowries with gold and so forth. And India also, theoretically, if we're going to have the central bankers trying to convince us that the world economy is going to start rebooting itself, well, that creates more wealth in India, in China, in cultures where people store their wealth in precious metals. This is a quagmire. There's just not enough physical gold to maintain these shenanigans that the cartel's running, and that's really going to be the end game. It's just a question of when.
Is there anything else you guys want to discuss?
Well, we should probably just put a footnote out about Paris, because of the timing of our last show. We didn't really have a chance to speak about it, but it's obviously a very important development, and from a geopolitical risk factor point of view in relation to precious metals, unfortunately, things are just going to probably continue to get worse and worse. Gerald Celente often tosses out the quip that when all else fails, they take us to war. And it really does seem like this whole slippery slope towards ever more global conflict is something that is still in play, and unfortunately, is in our future, including probable terrorist attacks within the United States, and that will change a whole lot. We're sitting on the edge of some very dark potential political developments domestically in terms of civil liberties further deteriorating. And, it's a dark scenario. But anyway, I happened to have interviewed Dr. Paul Craig Roberts yesterday. We talked a lot about Paris, and over the weekend we'll have a lot of coverage over on the News Doctors, and we don't need to get into all that stuff here because we'll be here for another half hour plus. So check out News Doctors. Probably Sunday I'll post that interview.
All right.
Look forward to hearing it, Eric.
All right. We'll wrap up this week's show here. Dave, it's always a pleasure to have you back on the show.
Well, again, thanks for having me. I always love chatting with you guys.
Yeah, great having you on.
All right. Well, hopefully we'll get a little bit of strength next week. But if memory serves, the second half of the week on Thanksgiving weeks is a favorite Fed time to smash the metals. I think every Black Friday that I can remember, silver is down hard. So we'll see if that trend continues. Maybe they'll give it away for free this year on Black Friday, guys.
Real quickly, did you guys see this news yet? Russia added another 600,000 ounces to their gold reserves in October.
Maybe they took it from J.P. Morgan.
It's another 18.7 tons.
What was the ton translation? Say that again, I'm sorry.
18.7 tons.
Well, they've been running at what?
Let's not forget that they've been funding that by selling their U.S. treasuries.
Right.
Meanwhile, Diamond and J.P. Morgan are down to, what, is it 5 or 10 tons they're down to now?
Yeah. And that reminds me as well, too, there is one other story we do need to touch on just briefly, and that's this whole IMF, SDR, China currency basket discussion. Back in, if memory serves, it was November 5th or November 13th that the IMF issued a press release, and Christine Lagarde went out and started talking to the media, and basically it was a public relations campaign, frankly, to try to put pressure on the voters, the shareholders who will make the decision as to whether or not the renminbi will be included into the SDR basket. And a lot of confusion has come from Bloomberg's coverage of it and the nature of the headlines they put out and all this. And there's a lot of people out here who actually think that the IMF has green-lighted China's entry into the SDR basket, and that's really not exactly true. What's going on is that on November 30th, we're going to have a vote with the shareholders casting yes or no as to whether or not to rejigger the SDR basket. And the United States has a 16.7% voting share, and in order to change the basket, you need 85% vote approval. So technically, the United States has a veto power. The votes are cast by Jack Lew, Treasury Secretary, and there's a division within the ruling elite in the United States in terms of how they view whether or not they should encourage China to go into the SDR or try to block it. And it's not a foregone conclusion that they're going to vote to let China in, and it may in fact be kind of something similar to what we saw back in 2010. Every 5 years they have these formal votes. And back then, the United States basically said, okay, from a conceptual point of view, we think this would be a good idea, and we're going to basically support it, but China, you got to do X, Y, and Z reforms, and let's talk about it going forward, and when those reforms come into place, we'll let you into the SDR basket. And that, in a nutshell, is what happened in 2010, and the signaling from the powers to be in the U.S. was that, okay, we're going to let this evolution to the SDR happen. And it's very conceivable that that kind of framing of delay, it's like the extend and pretend game that we see in so many other areas of finance. It's the same thing going on here with the United States position. I suspect that possibly may be what happens. So I just want to throw this out here as a caution, because a lot of people are writing articles in the blog space saying, well, then China has basically been green-lighted by the IMF, and that is not true. Essentially what happens is you have this structure in the IMF, which is the managing board. Christine Lagarde is the director, or the managing director, proper terminology, of the IMF board, and the IMF board has come to a consensus to vote to recommend the adoption of the SDR basket, but they're not the ones that cast the votes. The votes are held by the shareholders, so to speak, of the IMF, and it remains to be seen how the United States votes, because it has a veto. And we'll know November 30th what is the official policy. It'll be interesting to watch. In the long run, it's not going to really matter. I mean, China's momentum in terms of the use of the renminbi for world trade is pretty much unstoppable. It's going to continue to drive more and more transactions in the world economy, and that in turn, over the long term, impacts how much central banks hold in terms of reserves. So whether the SDR is kind of like a feather in their cap and helps them move along a tiny bit faster, is almost like a footnote in the grand scheme of history. But
yeah, I agree with that, Eric.
We'll know more on November 30th.
I agree. I think it's more put out there as a distraction, and I do think the U.S. is going to vote no.
Yeah, probably. But they'll package it kind of like what they did in 2010 with the framing that it enables the extend and pretend song and dance that they're doing with China. They'll say, well, you still need to do some more reforms, so come back to us later. we support your idea of coming in, but you still need to do X, Y, and Z.
All right. We'll wrap up the show here then. Dave, it's always great to have you back.
It's great to be back anytime. I appreciate it.
All right. Thanks for tuning in to this week's SD Weekly Metals and Markets.